Hello and welcome. Today we are breaking down the One Big Beautiful Bill Act, often called the OBBBA, and why it reshapes tax conversations from 2025 through 2028, with 2026 being the turning point for real planning, cleaner compliance, and fewer surprises. The OBBBA was signed on July 4th, 2025, and it works like a two-layer law. The first layer adds longer-term continuity for parts of the tax system, which improves multi-year planning. The second layer introduces new and mostly temporary deductions with caps, income phase-outs, and heavy documentation needs. In real life, that means more certainty in some areas, but more moving parts and more risk of missed or misapplied deductions if your intake and workflows are not updated now. Quick reminder, this video is educational. Your results depend on your filing status, income level, state rules, job type, and business structure. Now let's go step by step. Part 1, Individual Tax Changes. Let's start with what most people will ask about: employees, families, seniors, and taxpayers in high-tax states. First, the overall individual tax framework keeps a familiar structure, and inflation-related adjustments become especially relevant starting in 2026. The practical effect is that multi-year planning becomes more useful again. Timing income, timing deductions, choosing when to realize gains, and managing retirement distributions all become more strategic. But the center of gravity shifts toward modified income management, because several of the new deductions shrink or disappear as income rises. Second, the standard deduction increases and pushes more taxpayers away from itemizing. Many people who used to itemize will now stay on the standard deduction. But here is the key twist. The OBBBA introduces deductions that can still be claimed even when you take the standard deduction. So the main story for many taxpayers becomes these new deductions and how to document them correctly. Now let's cover the 4 new deductions that will dominate 2025 through 2028. Qualified Overtime Compensation Deduction. The first is the Qualified Overtime Compensation Deduction. It applies in tax years 2025 through 2028. The annual cap is $12,500 for single filers and $25,000 for joint filers. The phase-out begins once modified income reaches $150,000 for single filers or $300,000 for joint filers. Here is what you must communicate clearly. Many people hear no tax on overtime and assume all overtime becomes tax-free. In practice, explanatory summaries emphasize it is typically the premium portion of overtime rather than every dollar of extra pay. Also, this reduces federal taxable income, but does not automatically eliminate payroll taxes like Social Security and Medicare, and it may not eliminate state taxes. Operationally, documentation is everything. You want pay stubs, the W-2, and ideally an annual summary that clearly identifies the overtime premium portion. Without that, the deduction can be lost or challenged. Qualified tips deduction. The second big question will be tips. The qualified tips deduction also runs from 2025 through 2028. The annual cap is $25,000. The phase-out begins once modified income exceeds $150,000 for single filers or $300,000 for joint filers. This is where confusion becomes risk. Not everything that looks like a tip qualifies as a qualified tip. Voluntary tips are different from mandatory service charges or fees. In some industries, what the customer calls a tip may actually be a required charge, and that can change the tax treatment. The practical approach is to treat this as a definition plus evidence issue. Confirm occupation, confirm reporting consistency, and keep support that matches what is claimed. Additional senior deduction for age 65 and older. The third is an additional deduction for seniors age 65 and older. It applies in 2025 through 2028. The amount is $6,000 per eligible person, up to $12,000 if both spouses qualify. The phase-out begins at $75,000 of modified income for single filers or $150,000 for joint filers. A key detail is that this is in addition to the older age-based standard deduction increase that already existed. For many seniors who do not itemize, this becomes a very real planning lever. But the trap is the phase out. That is why modified income management becomes so important for seniors. Timing capital gains, managing retirement withdrawals, planning required minimum distributions, and reviewing Roth conversion strategy can all matter. Small changes in income can mean losing part of the benefit. Auto loan interest deduction for a qualifying vehicle. The fourth deduction is auto loan interest for a qualifying vehicle. It applies from 2025 through 2028. The annual cap is $10,000. The phase out begins at $100,000 of modified income for single filers or $200,000 for joint filers. The rules here matter. It generally applies to loans incurred after December 31st, 2024, for the purchase of a new vehicle for personal use. It does not apply to leases. Eligibility criteria must be confirmed. This deduction cannot be handled correctly without documents. Collect the loan agreement, the interest paid statement, the purchase paperwork, the VIN, and confirm dates and qualifying factors. Also, because of the phase out, run a modified income pre-check early. Many taxpayers will assume they qualify and later discover the benefit is reduced or eliminated. Part 2. SALT, the big shift for high-tax states. Now let's talk about the state and local tax deduction, commonly called SALT. The cap increases meaningfully for certain income levels, and then it is reduced for higher income taxpayers through income-based rules. In practice, this reopens the itemized versus standard deduction discussion for certain profiles, especially in high-tax states. It also forces a fresh look at timing state estimated payments, property tax timing, and cash flow planning. For pass-through owners, this can also bring entity-level strategies like PITET back into the conversation where applicable. Part 3, Form 1099, K threshold returns to a more classic federal level. Another operational change is the Form 1099-K threshold. At the federal level, the threshold returns to more than $20,000 and more than 200 transactions for certain platform reporting. Here is the practical trap. States may still have lower thresholds and issue state-level forms. Also, not receiving a 1099-K does not remove the obligation to report income. It only changes the paper trail. That is why reconciliation remains essential for digital businesses, e-commerce, creators, freelancers, and anyone paid through platforms. Part 4. Business tax changes. Now we move to business changes. This is where the OBBBA affects investment, interest, research and development, and multi-state planning. Section 1, 74, Research and Development. One of the biggest changes is research and development expense treatment. Domestic research and development moves back toward immediate deduction. But there is a major planning warning. If a company accelerates unamortized costs from earlier years into 2025, it may end up with higher federal tax in 2026 compared with 2025, depending on the overall income and limitation profile. That is why the right answer is not automatic. It is modeling. The practical method is to build scenarios, at least 2 or 3. One scenario accelerates everything into 2025. Another spreads between 2025 and 2026. Then test how taxable income changes, how interest limitations interact, how net operating losses and credits behave, and how state conformity changes the outcome. Section 163, J Business Interest Limitation. Another key business item is the business interest limitation. The calculation becomes more favorable under an approach that is closer to EBITDA when determining adjusted taxable income. That can raise the amount of interest a debt-heavy business can deduct. Practically review debt structure, refinancing timing, and forward projections. If the business has an interest-heavy model, this can change financing decisions. State conformity and a craft-type opportunity. This is one of the most strategic areas for companies with international activity. Under the OBBBA framework, Domestic research and development may be immediately deductible, while foreign research and development remains amortized over 15 years. If a state conforms to the federal code, that state could be adopting a structure that discriminates against foreign commerce, which can open constitutional arguments similar to Kraft versus Iowa. This requires a disciplined approach. Identify clients with foreign research and development, map the states where they file, analyze conformity rules, and quantify the impact to decide whether there is a defensible position or a potential refund strategy. Part 5. International changes that hit hard in 2026. Now let's talk about international. If your firm serves clients with controlled foreign corporations, offshore structures, intellectual property, or supply chains involving related parties, then 2026 is the year to recalibrate. Summaries describe significant changes to the GILTI type framework that can increase the taxable base for United States shareholders of controlled foreign corporations, especially where prior mechanics reduced exposure for asset-heavy structures. There are also changes tied to Section 250 and effective rate outcomes, as well as references to FDII, BEAT, and structural modifications. The practical translation is straightforward. Rebuild effective tax rate models, revisit foreign tax credit planning, review supply chain and intercompany pricing, and reassess the balance between tangible and intangible assets, because when the mechanics of tangible returns change, incentives change. Do not ignore the state layer. Several states include a portion of GILTI type income. If a state includes foreign subsidiary income under a unitary concept, it must treat it consistently in apportionment. Including it for tax but excluding it for apportionment creates risk and can become challenge territory. Part 6. How to prepare now for 2026. The most important message for practitioners is that if you wait until April, you are late. Process is the defense. First, redesign your intake and organizers. Add dedicated capture for overtime, tips, auto loan interest, age 65 qualification, SALT modeling, and modified income tracking for phase-outs. Second, define minimum documentation. For overtime, pay stubs, W-2, and an annual premium summary. For tips, reporting evidence and clarity on what qualifies. For auto interest, the loan agreement, interest statement, VIN, and eligibility confirmations. For seniors, proof of age, and a modified income calculation to protect the benefit. Third, communicate clearly. Clients will think no tax means fully tax-free. Explain it is a deduction that reduces taxable income. It is not a credit, and it does not automatically erase payroll taxes. Fourth, for businesses, build a 2026 playbook. Model research and development scenarios at both federal and state levels. Document foreign research and development footprints. Review state inclusion policies for GILTI type income. Monitor state decoupling. And evaluate transferable credit markets early if the client participates. Bottom line, the OBBBA combines longer-term continuity with a package of temporary deductions that will drive client questions and documentation burdens, plus major business, state, and international implications that make 2026 the year to model and update processes, not improvise. If you want us to apply this to your specific situation, whether you are an employee with overtime or tips, a senior managing retirement income, a buyer of a qualifying vehicle, a high-tax state taxpayer, or a business with research and development or international structure, we can help with projections, documentation, and strategy.